A sudden ripple is sweeping across the world of global finance, and it is coming from a place most ordinary observers rarely notice. Washington has issued a message so strong that it could redirect billions of dollars, while major regions in Asia quietly adjust their financial strategies. This is not just routine policy, it is a strategic move with potential consequences that stretch across continents. At the heart of this situation lies a sharp divergence. While the U.S. is pushing international investors to increase holdings of government debt, several Asian economies are stepping back from borrowing in U.S. dollars. Two opposing forces are now shaping the future of global finance, with potential consequences for interest rates, market stability, and the dollar's position as the world's dominant currency. In this video, we will explore why the United States is pressing so aggressively to maintain demand for Treasury bonds, and why Asian governments and corporations are reducing or canceling dollar borrowing. We'll uncover the mechanisms behind these decisions, their effects on markets, and their impact on economies and households around the globe. These actions are far from random, they reflect broader concerns about sovereign debt, geopolitical risks, inflation, supply chain vulnerabilities, and the competition for financial influence. Most news coverage scratches only the surface. The real story lies beneath, in quiet policy shifts, private guidance to major investors, and rising concerns over the long-term stability of the U.S. financial system. By the end of this video, you will understand why some countries are moving away from the dollar, why Washington is striving to maintain global demand, and how this tug-of-war could directly affect your economy, currency, and even the value of your savings. Stay with us until the end, because we will reveal an often overlooked fact that global banks monitor daily but that most ordinary people never hear about. Once you understand it, the entire situation will make far more sense. This is not just another financial report, it's a story of power, hidden pressures, and strategic decisions that could influence the next decade. Watching until the end will give you clarity on why experts are concerned and how the world's shifting financial balance could touch your life in ways you might not expect. Welcome to our channel, where we simplify complex global events and make them understandable. If you want to stay informed about global finance, geopolitics, and the forces shaping tomorrow's economy, make sure to subscribe. Your support enables us to deliver deeper insights, clearer explanations, and actionable analysis every day. Treasury Secretary Scott Bessent is not an ordinary government official. Before taking his role in Washington, he managed billions of dollars in global markets, studying investor behavior, financial crises, and the movement of capital. That expertise now informs every statement he issues. Recently, he delivered one of his most forceful messages yet, a direct call for global investors, including banks, pension funds, and major institutions, to increase their holdings of U.S. government debt. The instruction is explicit: not to reduce, not to diversify, but to increase exposure. Buy more U.S. bonds, hold dollar-based assets, and prioritize the United States in international portfolios. Bessent's appeal comes at a critical juncture. Foreign demand for U.S. debt has shown signs of fluctuation, with some investors slowing purchases and others withdrawing entirely. Rising interest rates, market volatility, and global uncertainty are prompting countries and corporations to reassess their exposure to dollar-denominated borrowing. In this context, Bessent's message is far more than routine. It is a strategic signal aimed at maintaining robust global demand, stabilizing domestic borrowing costs, and protecting the financial system from potential shocks. U.S. Treasury bonds act as the anchor of global finance. When demand weakens, that anchor becomes less stable. By urging investors to maintain and even increase their holdings, Bessent is seeking to preserve stability, keep yields predictable, and reinforce the dollar's position as the primary global reserve currency. The global demand for U.S. debt is more than a financial metric, it is a cornerstone of the international monetary system. When demand wanes, the United States faces higher borrowing costs, which ripple through the entire financial ecosystem. Even modest reductions in foreign purchases can force the U.S. government to raise yields to attract alternative buyers. Higher yields are not confined to the government. They affect corporate financing, mortgage rates, small business loans, and even the borrowing costs of other countries that rely on dollar-denominated debt. Markets become more volatile, investor confidence can erode, and financial stability is tested. Scott Bessent understands these risks intimately. His urgent message is not simply about selling more bonds, it is about defending a system built on global trust, a system that has granted the United States enormous influence but is now under quiet pressure, especially from major Asian economies. Across Asia, corporations, investors, and even government-linked entities are beginning to reevaluate their reliance on U.S. dollar debt. This shift is not loud or dramatic, but it is unmistakable. Dollar-denominated loan demand is softening. Bond issuances in dollars are slowing, and regional funds are gradually reallocating toward local currencies or alternative markets. One major driver of this trend is the sharp rise in U.S. interest rates. Borrowing in dollars has become considerably more expensive than it was just a few years ago. For Asian companies that rely on overseas funding, higher interest payments reduce profitability, strain balance sheets, and increase financial risk. Businesses operating in sectors with slow growth or thin margins are particularly vulnerable. Currency risk adds another layer of complexity. Companies that earn revenue in local currencies but borrow in dollars face higher repayment costs if the dollar strengthens. Recent years have repeatedly demonstrated this risk, and many firms are now cautious about overexposure to U.S. debt. Volatility in U.S. linked markets further amplifies concerns. Sudden changes in interest rates, unexpected economic data, or geopolitical events can trigger rapid swings in the dollar. For borrowers in Asia, these fluctuations make dollar-denominated loans riskier and less attractive. Meanwhile, global lenders have tightened credit conditions, making refinancing or rolling over dollar debt more challenging. This encourages companies and governments to explore safer, more predictable funding options, such as local currency markets or alternative sources. Several Asian governments are actively promoting domestic financing as a way to reduce dependence on the U.S. dollar system. Despite these pressures, U.S. Treasury bonds remain a critical safe haven for conservative investors. Central banks, large institutional funds, and risk-averse investors continue to see treasuries as one of the most secure investments worldwide. This creates a nuanced landscape. Some investors reduce exposure due to rising costs and perceived risk, while others increase holdings for stability and reliability. The result is a fragmented, complex financial environment, reflecting the competing priorities and strategies of global capital. The unique position of U.S. government debt is supported by its reputation for safety, size, and reliability. Treasuries are often considered the world's safest large-scale investment. This trust underpins what economists call the exorbitant privilege, allowing the U.S. to borrow at lower costs because global investors depend heavily on its bonds. Sustained demand enables the U.S. to finance its budget efficiently, manage debt more effectively, and maintain predictable domestic interest rates, benefiting businesses, governments, and households alike. However, this delicate balance is now being tested. Even minor reductions in demand from major Asian holders, such as China, Japan, or South Korea, can create upward pressure on yields. Rising yields increase borrowing costs and have cascading effects across the global economy, potentially straining countries already facing debt, slower growth, or inflationary pressures. Investors may begin to question the sustainability of the U.S. borrowing model, challenging the dollar's long-standing role as the primary global reserve currency. Several scenarios may unfold in the coming months. In one, investors respond positively to Bessent's appeal, increasing their treasury holdings. Demand rises, yields remain low, and borrowing costs are stable. This environment supports economic stability, predictable interest rates, and continued confidence in U.S. debt. Capital flows remain relatively predictable, reducing volatility across financial markets. In another scenario, Asian investors continue to step back from U.S. debt. Persistent withdrawals, lower overall demand, push yields higher, and increase borrowing costs. Economies already under pressure experience further strain. Investor confidence may erode, prompting questions about the sustainability of U.S. debt financing and potentially altering the dollar's dominance in global finance. A third scenario is a fragmented outcome. Some investors increase exposure while others pull back. This uneven capital flow creates volatility, with inflows and outflows affecting different regions at different times. Bond prices fluctuate sharply, currency markets experience rapid shifts, and market sensitivity to economic and geopolitical developments intensifies. Even routine data releases or policy announcements can trigger outsized reactions, illustrating the fragility of a system under simultaneous opposing pressures. For households and businesses, these changes are far from abstract. Rising bond yields influence inflation, pushing up the cost of goods and services. Higher borrowing costs slow business expansion and raise mortgage and loan rates. Currency fluctuations affect import and export pricing, impacting everything from energy and food to industrial machinery and technology. Savings and investments linked to the dollar fluctuate, even for people in countries far removed from the U.S. financial system. Awareness of these connections allows individuals and companies to plan better, manage risks, and make informed decisions in an interconnected global economy. The tug-of-war between Washington and Asia represents more than just a financial story. It is a strategic contest over global capital flows. The U.S. is determined to maintain the centrality of its debt and the dollar, while Asian economies quietly diversify, reduce exposure, and strengthen local financial markets. Analysts debate whether this represents a natural recalibration after decades of dollar dominance, or the early signs of a structural shift in global financial power. Either way, the stability that has anchored global markets for decades is under unprecedented pressure, and the consequences will resonate for years to come. The global financial system is delicately interconnected, and Asia's role as a major holder of U.S. debt is central to that balance. Even small reductions in purchases by these economies can force the United States to raise yields to attract alternative buyers from Europe, the Middle East, or other regions. Higher yields increase borrowing costs for the U.S. government and have far-reaching consequences. Corporate financing becomes more expensive, mortgage rates climb, and even governments that rely on dollar-denominated debt face additional strain. These shifts can ripple across economies already grappling with inflationary pressures, slow growth, or geopolitical uncertainty, magnifying risks that were once manageable. Treasury Secretary Scott Bessent understands the stakes. His recent call to global investors to increase holdings of U.S. debt is not merely a routine policy statement. It is a strategic move aimed at stabilizing markets, protecting the financial system, and reinforcing the centrality of the dollar. U.S. Treasury bonds serve as the anchor of global finance. When demand falters, that anchor becomes less stable. Bessent's message emphasizes the importance of maintaining strong demand, keeping yields predictable, and ensuring the dollar retains its dominant position in global trade and finance. At the same time, subtle shifts are occurring across Asia. Corporations, investors, and government-linked entities are gradually reducing reliance on dollar-denominated borrowing. Loan demand in dollars has softened, and regional funds are increasingly reallocating portfolios toward local currencies or alternative markets. Rising U.S. interest rates make borrowing in dollars more expensive, particularly for companies operating in sectors with thin margins or slow growth. Currency risk further complicates the picture. When revenue is earned in local currencies, a stronger dollar makes debt repayments heavier. Many Asian firms remember previous episodes of dollar volatility and are now proceeding cautiously, minimizing exposure to potential shocks. Volatility in U.S. linked markets has become another factor driving change. Sudden policy shifts, unexpected economic data, or geopolitical events can trigger rapid movements in the dollar, making it riskier for companies that borrow in dollars. Credit conditions have tightened globally, making refinancing and rolling over dollar debt more challenging. These factors incentivize borrowers to explore safer, more predictable alternatives, such as local currency loans or domestic capital markets. Some Asian governments are even encouraging local currency borrowing to reduce dependence on the dollar system. Despite these pressures, U.S. Treasuries continue to attract investors seeking safety and reliability. Central banks, institutional funds, and risk-averse investors still view U.S. debt as one of the most secure, large-scale investments globally. This creates a complex landscape. Some investors reduce exposure due to rising costs and risks, while others increase holdings to preserve capital in a stable environment. The financial system becomes fragmented, reflecting the varying strategies of global capital in response to rising interest rates, market uncertainty, and shifting geopolitical landscapes. The unique position of U.S. U.S. government debt is underpinned by its safety, reliability, and scale. Treasuries are often considered the world's safest investment, earning the United States what economists call the exorbitant privilege, the ability to borrow at lower costs because global investors depend heavily on its bonds. Sustained demand allows the U.S. to finance its budget efficiently, manage debt responsibly, and maintain stable domestic interest rates. This stability benefits businesses, governments, and households, providing predictable borrowing costs and fostering global financial confidence. However, the balance that has historically stabilized markets is now being tested. Even minor reductions in demand from Asian holders can create upward pressure on yields, increasing borrowing costs and straining economies that are already vulnerable. Investor confidence may waver, leading to broader questions about the sustainability of U.S. debt financing and the dollar's role as the global reserve currency. Several scenarios could unfold in the near future. In the first, global investors respond positively to Bessent's call, increasing Treasury holdings. This maintains low yields, stable borrowing costs, and market confidence. Businesses and households benefit from predictable interest rates, and capital flows remain orderly, supporting stability across global markets. In a second scenario, Asian economies continue to reduce exposure to U.S. debt. Declining demand pushes yields higher, borrowing costs rise, and investor confidence may weaken. Economies already under pressure face additional strain, and questions about the long-term sustainability of U.S. borrowing could emerge. A third scenario presents a mixed outcome. Some investors increase holdings while others withdraw. This creates volatility, as inflows and outflows affect regions unevenly. Bond prices fluctuate, currencies move unpredictably, and markets become highly sensitive to economic and geopolitical developments. Even routine data or policy announcements can trigger outsized market reactions, reflecting the system's fragility under opposing pressures. For households and businesses, these developments have real-world consequences. Rising bond yields influence inflation, increasing the cost of goods and services. Higher borrowing costs slow business expansion and raise mortgage and loan rates. Currency fluctuations impact import and export pricing, affecting everything from energy and food to industrial machinery and technology. Even people in countries far from the U.S. financial system feel these effects through savings, investments, and day-to-day expenditures. Awareness of these dynamics enables better planning, risk management, and informed financial decision-making in an interconnected global economy. The tension between Washington and Asia is more than a financial story, it is a strategic contest over global capital flows. The U.S. aims to maintain the centrality of its debt and the dollar, while Asian economies quietly diversify, reduce exposure, and strengthen domestic financial markets. Analysts debate whether this is a natural recalibration after decades of dollar dominance or an early sign of a structural shift in global financial power. Either way, the stability that has underpinned global markets for decades is now under unprecedented pressure, with implications that will resonate for years to come. The dynamics surrounding U.S. debt are not just a matter of numbers on a spreadsheet, they influence economies, businesses, and households worldwide. Asia, holding some of the largest foreign reserves of U.S. Treasury bonds, plays a pivotal role in maintaining this balance. Even a modest reduction in purchases from these countries can force the United States to offer higher yields to attract buyers from other regions such as Europe or the Middle East. Higher yields increase borrowing costs across the board, affecting corporate loans, mortgages, and government debt globally. Economies already facing inflationary pressures or slow growth are particularly vulnerable to these shifts, creating ripple effects that reach far beyond financial markets. Treasury Secretary Scott Bessent's urgent message to global investors emphasizes the importance of strong demand for U.S. debt. He is not merely suggesting investors buy bonds, he is signaling that maintaining stability in global financial markets, controlling yields, and ensuring confidence in the U.S. dollar are critical for both domestic and international economic health. U.S. Treasury bonds are often referred to as the anchor of global finance. When demand falters, that anchor becomes less stable, potentially triggering broader market volatility. Bessent's call underscores the delicate balance the U.S. must maintain. securing global trust while keeping domestic borrowing costs predictable. Meanwhile, subtle but significant shifts are occurring across Asia. Corporations, institutional investors, and government-linked entities are gradually reducing their reliance on dollar-denominated borrowing. Loan demand in U.S. dollars is softening. Bond issuances in dollars are slowing, and several regional funds are reallocating portfolios toward local currencies or alternative markets. The primary driver is the sharp rise in U.S. interest rates, which makes dollar-denominated loans more expensive for companies already operating with tight margins. Higher borrowing costs reduce profitability and increase financial risk. Currency volatility adds another layer of complexity. Companies that earn revenue in local currencies but borrow in dollars face heavier repayment burdens if the dollar strengthens, a challenge they are increasingly cautious about after previous market shocks. Volatility in U.S. linked markets reinforces these concerns. Sudden policy changes, unexpected economic data, or geopolitical tensions can trigger rapid fluctuations in the dollar, making borrowing in U.S. dollars riskier. Global lenders have tightened credit conditions, making it harder to refinance or roll over debt, which incentivizes borrowers to seek more predictable funding options, such as domestic capital markets or loans in local currencies. Some Asian governments are actively promoting these alternatives to reduce dependency on the dollar system and strengthen financial independence. Despite these pressures, U.S. Treasury bonds continue to attract risk-averse investors. Central banks, large institutional funds, and conservative investors view treasuries as a secure and reliable investment, creating a fragmented but resilient landscape. Some investors reduce exposure due to rising interest rates and market volatility, while others increase holdings to safeguard capital. This duality highlights the complex nature of global capital flows, reflecting how different regions respond differently to the same set of pressures. The special status of U.S. debt comes from its reliability, scale, and the stability of the U.S. financial system. Treasuries are considered one of the safest large-scale investments worldwide, enabling the U.S. to borrow at lower costs, manage debt effectively, and maintain stable domestic interest rates. This stability benefits businesses, governments, and households, providing predictable borrowing costs and fostering global confidence. Economists often refer to this as the exorbitant privilege, reflecting the United States' ability to maintain lower borrowing costs because of global reliance on its bonds. However, the balance that has historically stabilized global markets is now under pressure. Even small reductions in demand from major Asian holders, such as China, Japan, or South Korea, can lead to higher yields, increased borrowing costs, and heightened market volatility. Investors may question the long-term sustainability of U.S. debt financing, challenging the dollar's position as the world's primary reserve currency. The implications of these shifts extend far beyond financial markets. They influence inflation, trade, economic stability, and policy decisions across the globe. Several scenarios could emerge. In one, global investors respond positively to Bessent's appeal, increasing treasury holdings. Demand rises, yields remain stable, and borrowing costs stay low. Markets experience relative calm, providing predictable conditions for businesses, governments, and households. Capital flows remain orderly, and confidence in U.S. debt and the dollar is reinforced. In a second scenario, Asian economies continue to reduce their exposure. Persistent withdrawals lower overall demand, push yields higher, and increase borrowing costs. Economies already under strain face additional challenges, and investor confidence may erode. Questions about the long-term sustainability of U.S. borrowing could arise, and the dollar's dominance may be gradually challenged. A third scenario is a mixed outcome. Some investors increase holdings, while others reduce exposure. This creates volatility, as inflows and outflows affect regions unevenly. Bond prices fluctuate sharply, currency markets experience rapid shifts, and financial systems become highly sensitive to global economic and geopolitical developments. Even routine data releases or policy announcements can trigger outsized reactions, revealing the fragility of a system under opposing pressures. For households and businesses, these shifts have tangible effects. Rising bond yields influence inflation, driving up the cost of goods and services. Higher borrowing costs slow business expansion, increase mortgage rates, and make credit more expensive. Currency fluctuations impact the price of imports and exports, affecting everything from energy and food to industrial machinery and technology. Savings and investments linked to the dollar fluctuate, even for people in countries far from the U.S. financial system. Awareness of these dynamics allows individuals and organizations to plan more effectively, manage risks, and make better-informed financial decisions in a globally interconnected economy. The tug-of-war between Washington and Asia represents more than just a financial story. It is a strategic contest over global capital flows and influence. The United States is determined to maintain the centrality of its debt and the dollar, while Asian economies quietly diversify, reduce exposure, and strengthen local financial systems. Analysts debate whether this is a natural recalibration after decades of dollar dominance or the early stages of a structural shift in global financial power. Either way, the stability that has anchored global markets for decades is being challenged, with profound consequences for the global economy and everyday life. Even if you never buy a U.S. Treasury bond, the global movement of money directly influences your everyday life. The demand for U.S. debt impacts the dollar, and the dollar affects prices worldwide. When the dollar strengthens, imports become more expensive for many countries, driving up the cost of goods and services. When the dollar weakens, some products may become cheaper, but financial risks can increase. These fluctuations spread across supermarkets, fuel stations, retail stores, and industrial supply chains, influencing everything from food and energy to electronics and machinery. Emerging markets feel these changes more acutely. Governments borrow in dollars, companies take dollar loans, and central banks maintain reserves in U.S. dollars to stabilize local currencies. When the dollar strengthens, debt repayments rise, putting pressure on local budgets. Inflation can climb as imported goods become more expensive, and interest rates may be increased to protect local currency values, making mortgages and business loans costlier. Even minor movements in global demand for U.S. debt can therefore touch everything from government spending to the price of basic goods. Investment markets respond swiftly. Bond yields, stock indices, commodity prices, and real estate markets all react to changes in Treasury demand. International funds adjust portfolios, capital flows move in and out of countries, and these dynamics affect corporate profits, economic growth, and employment. For households, the connection may seem invisible, but it is ever present. Whether saving money, taking loans, or running a business, global financial shifts eventually reach you. Rising global interest rates can limit investment opportunities. Currency depreciation can increase import costs. Market volatility can create uncertainty for families planning long-term purchases or businesses budgeting for expansion. Scott Bessent's urgent message is more than a call to buy bonds. It signals the U.S. commitment to maintain strong demand for its debt and to preserve the dollar's central role in global finance. High demand allows the United States to borrow at lower costs, maintain stable interest rates, and safeguard the overall financial system. When a Treasury Secretary directly urges investors to increase holdings of U.S. debt, it reflects the extraordinary importance of global trust and predictable capital flows for maintaining economic stability. Simultaneously, Asia's gradual retreat from dollar borrowing reflects caution and, in some cases, skepticism about the long-term reliability of the U.S. financial system. Rising interest costs make dollar-denominated loans harder to manage, while volatile markets heighten exposure risk. Several Asian institutions are exploring alternatives, strengthening local currency financing and diversifying funding sources. Though these changes are incremental, they create mounting pressure on a system that was long considered unshakable. The resulting tension is quiet but powerful. On one side, the U.S. reinforces the central role of its debt and the dollar. On the other, major Asian economies test alternatives, reducing vulnerability to potential shocks. This clash highlights deeper changes in the global financial order, signaling either a natural recalibration after decades of dollar dominance or the early stages of a structural shift in global economic power. Analysts debate which scenario will dominate. But one fact is clear: the balance that has historically stabilized global markets is now being challenged. Monitoring key indicators is essential. Bond yields reflect investor confidence in U.S. U.S. debt. Dollar strength shows how markets respond to policy and demand changes. Capital flows indicate which regions are gaining influence and which are stepping back. These movements impact inflation, trade conditions, and economic stability, guiding government responses and shaping global growth trajectories. For ordinary people, the implications are profound. Rising yields affect borrowing costs for homes, businesses, and governments. Inflationary pressures make everyday goods more expensive. Currency fluctuations influence import and export pricing. Savings and investments tied to the dollar can shift in value, even for those living far from the U.S. financial system. Understanding these links empowers individuals, businesses, and governments to make better informed decisions in a highly interconnected global economy. The contest over U.S. debt and the dollar is not confined to financial elites. It touches households, businesses, and national economies worldwide. Watching these developments closely, questioning headlines, and understanding how global capital flows influence your life is essential for anyone seeking to navigate today's economic landscape. Will global investors respond to Bessent's call and maintain strong demand for U.S. debt? Or is the world gradually moving toward a multi-currency financial system that reduces reliance on the dollar? The answer will shape markets, influence policies, and affect daily life for billions of people across the globe. In our next video, we will explore how these global shifts could impact emerging economies, including Pakistan, and what the changing dynamics may mean for households, businesses, and government policies. If you found this video informative, please like it and subscribe to our channel. Your support allows us to continue delivering clear, in-depth insights into global finance, geopolitics, and the forces shaping the world economy. Global finance is no longer a distant concept. It affects the prices we pay, the value of our savings, the cost of borrowing, and the stability of our financial systems. By understanding the movement of money worldwide, you gain perspective, anticipate risks, and make smarter financial decisions. The tug-of-war over U.S. debt and the dollar is quietly reshaping the financial world. Those who understand it will be better prepared to navigate the uncertainty and opportunity it brings. This is not just a story about bonds or currencies. It is a story about power, trust, and the decisions that shape the next decade. By staying informed, you can see the bigger picture, understand the forces at work, and protect your financial future in a world where even distant policy moves can touch your daily life. The quiet tension between Washington and Asia may be invisible to most, but its consequences are real, immediate, and far-reaching. And that is the story unfolding right now, one that will shape the global economy for years to come.